So with that, we're going to jump in.
Wait,
and
the fact that there's an official record here already makes me nervous.
I know. Yeah, we'll see how it goes. I don't know. We'll see. Okay. So I know you've been walking around the room. This is Ramsey Goodrich. I'm going to give you an intro. Probably, you can jump in if you want. So Ramsey's managing partner at Carter Morse Goodrich. I'm going to refer to it as CMG, a boutique investment bank here in Connecticut, right? Okay. Ramsey's doing about 500 million a year in deals. That number's going up, right? We want it to go up. Okay. So one of the things Ramsey and I met, what I do is I coach entrepreneurs using a framework called EOS. And I met Ramsey through it because Ramsey runs his business on EOS. And I remember, no offense, I've never told you the story.
What happened to no solicitation? You told me.
Yeah, now everyone thinks there's a sales. So I remember this, you've never heard this story and I'm going to insult you. So,
oh God, here it comes.
So I remember when, so I forget who introduced us, but I was like, oh, I'm going to go speak to this investment bank, right? And thinking this guy's going to be uptight. He's just got all the numbers. And one of the things I admired the first time I met Ramsey was we didn't talk about numbers at all. We were talking about culture and people and saying no to deals, which like who says no to deals being a CEO of a company, right? But this guy is talking about saying no to deals. And I thought the way that he operated in general was just incredible. And so I thought beyond the stuff, like the CEOs I talk to, everybody wants to know about M&A, whether it's buying businesses or selling their businesses. He's the expert at that, but he's also a great operator. The way that he thinks about building a business, the way that he thinks about organizing people. So today we're going to jump into kind of two buckets. The first is operating a boutique investment bank, how you think about leading people. And then the second part of the talk, we'll talk about M&A. So thinking about selling businesses, the process, et cetera. Anything I missed?
Not that I want to admit.
Okay, cool. Okay, so just before we jump in, what does CMG do? And give us roughly a size and scope.
So thank you. First of all, thank you. I'm thrilled to be here. It's great to see a lot of familiar faces here. A lot of us were at the manufacturing event earlier this morning, so cool to just recycle it again. But this is even better. So CMG, Carter Morse, is a boutique investment bank in Southport, Connecticut, and Providence, Rhode Island. Now,
okay.
That we are we represent exclusively families and founders doing their once-in-a-lifetime transaction between 50 and 150 million, where they value great advice, where they're willing to invest in their success, where value means more than money. You want to talk about a clarity of vision and purpose? That's it. But that purpose and that passion and that clarity and that core values has enabled us to just, believe it or not, narrow our focus and do what we're really good at. So for 30 years, as my partner Michael ran the company, we were a full service investment bank to the middle market. I dare anyone in the room to define any of that. For 30 years, I have no idea what that means.
Right.
So now we are sell-side M&A advisors for families and founders. And so now that clarity says, you know what? I don't have to do buy side. I don't have to do capital raises. I don't do strategic analysis anymore. We're not doing debt financing. We're not doing IPOs and everything else that every full service investment bank does. But that clarity of focus has really allowed us to say, we're not going to do that.
So I know you say that and it sounds easy and crisp when you say it, but when you're doing something as a CEO and you're making money off it, it's hard to say we're going to stop doing this. Right? Because
especially in this M&A market.
Fear.
Yes.
Yeah. So how did you guys go through the process of really narrowing that focus?
So it's been a journey for sure. Back in 2000, and a bunch of you guys know my partners. So before we joined up with a company called DeVischer & Company, that was really a family consulting business that happened to do M&A. We went back and we said, oh, this could make sense. This could be really cool and revolutionary for us. But we needed to go back and say, what did we do? So we looked at 30 years of deals and said, where did we have the biggest impact? Where did we have the most fun? Where did we make the biggest difference? And frankly, where did we make the most money? And we looked back and what was that? It's family businesses where we make a real difference. Private equity guys flipping portfolio companies to private equity guys, you don't need us. Right. You don't need it. But you're doing a once in a lifetime transaction it's really important you do it right. And there's so much that goes into a transaction. We were talking earlier, Mandy, about what it was to sell your dad's business. And oh my God, it's emotional. It's a roller coaster. It's the ultimate highs, it's the ultimate lows. You need a steady hand to get through that. So as we're looking back in 2019 of potentially doing something with this division company, that clarity said, oh, yep, okay, this makes a lot of sense. From 2019 to about 2022, we did sort of some strategic thinking of where we want to go and what do we want to do, and we grow up. And it was good. We fixed some operational stuff, but we didn't have that clarity of vision of where we were going. And then in 2023, in sort of the depths of the M&A crisis and COVID, we had plenty of free time on our hands. And so we said, well, what do we want to do when we grow up? And so that was where it said, we came up with our 10-year vision, our 3-year objectives, our 1-year goals, our core values. So it's funny, I went on to ask you a question. When folks get on EOS or any other platform that's relevant, and you talk about core values, what we hear from most implementers is that process of figuring out what core values is really hard.
Yeah.
Most people come up with honesty, integrity, hard work.
Trust.
Can I use bad language?
Yeah.
That's all bullshit.
Yeah.
If you don't have honesty when you walk in the door, I'm going to fire you on day one anyway. If you don't have integrity, you're not walking through my door. Hard work, that's foundation, right? So what is it something you aspire to be? What do you do? And so when we got through our core values, it was actually really easy because it was so ingrained in our culture every day that it was the easy part.
Yeah.
Which is weird because it's normally the hard part.
Mm-hmm.
So with that clarity of focus, with that core values, now we sort of said, okay, what do we want to do? Ready? Running through walls, whatever, wherever. No excuses. Take ownership, be accountable, get it done, be proactive. Insatiable curiosity. Ask why 5 times. Why? Because that's when you make your aha moment. That's when you figure out what's truly driving that business owner to figure out why you want to do something. You've got to be humbly confident. Wait, hold on a second. Those are two opposite things. How do those things go together? Check your ego at the door. You don't know how to make a widget. You don't know where this guy's been. You don't know how the family legacy has been there. But you're being hired as the expert. So you got to give really great advice, but be humble about it at the same time. Team player, you're going to work not only internally within our team, but externally with the family or founders that are running their transaction and all of their other advisors. You cannot get any of this done without having a full team. And most importantly, engage personally. I know more about my clients' kids and their families and the grandkid that's showing up and stuff like that. That's more important than the last dollar, without question. You thought you were going to get me, didn't you?
No, I mean, I think people,
and we live it passionately.
Yeah.
I'm the last guy to interview anybody that comes in. I don't care about your resume. You're smart. You passed a financial exam doing a interview. You've made it past all my VPs. You made it past all my other managing directors. When you get to me, I only talk about 5 things. Those 5 things. That's it. That's all I care about.
Yeah, my experience, most hiring mistakes aren't skills, it's personality mismatch. And I think that people think that core value, I did think that they're bullshit because most people slap them on a wall and then go ask an employee what that means. And they're like, I've never heard that, right? I think it comes down to the fact that every business has a personality, right? Like we all have personalities. Every business has a unique personality. What is that personality? I think it's defining what that means. So for example, in my merchandising business, everybody, I don't know why I'm talking. You're supposed to.
No,
everybody in the industry, they would wear headphones when they walked in. So merchandising, putting products on shelf, right? So we're going to go and we're going to put products on shelf and they just wore headphones. And in our business, what we did was no headphones. Like you can, and the way that we became the largest merchandiser is because our people walked into these stores and they went to the buyers and they went to the clerks and they went to the people in the back, right? Packing boxes out. And they asked how their family was, what was going on in their lives. When you do that at scale across 5,000 stores, now those stores trust you and they like you. And when you ask for a favor, they give it to you because they know you. And so one of our values is like, no headphones. You could be a successful merchandiser if you wear headphones, just not in my company. Right. And so I think that's what like values means is, as a leader, it's having conviction around what your personality is and recognizing 9 out of 10 people won't fit that personality. Right. And I think that's misunderstood in operating a business. It's hard.
Yeah.
So you want to say yes.
It's really hard because we're interviewing for some managing directors right now. One guy came in with perfect resume. Aerospace and defense, does 5 deals a year, generates millions of dollars in revenue every year. On paper was great, did great phone interview, came in, met with us, didn't ask a single question. Well, what happened to insatiable curiosity? Right. Don't you want to know what we do for a living and how we do it, why we think we're different? Nothing. Yeah, he was more there just to generate revenue and get the next deal done. And like, nope, he was not invited back.
Totally. So, okay. So you came in, you've kind of wrapped your arms around CMG, or you're kind of running point and leading things. I find that when somebody comes in and they take and really drive the business forward, they see something that the previous leadership did not see. What was something that you saw that was like an obvious, we got to go after this?
And I know it's such a weird word to say, right? But you look at what we do and how we're different and the differences that we make in people's lives. It's incredible. We closed a big deal on Thursday last week, and after the closing call, we're all on Zoom, which closing calls now are really boring. But as soon as you close it, you let the buyer side hang up, then the lawyers hang up, and that's just you and your client, right? This guy has been a tough-nosed negotiator from day one. He runs a construction company up in northern New England. He is tough as nails, right? He broke down crying on our call to say, this was really meaningful for us. You've ignored my family, my employees, my company, my legacy. I'm so excited about this partnership that comes back up. I can't wait. But he started crying on the phone. With 2 exceptions, I've never had that happen before. That's why we do what we do. The money's great. The transaction's fun. Sometimes it's a pain in the ass. But that's why we do what we do. And if you keep that in your heart and out in the forefront, that's what makes the difference. So the opportunity to do that for more makes sense. We've been a hardworking lifestyle business for 30 years. And it's only after adding some new partners and adding some more risk by hiring more people, thanks to the clarity we have now that momentum is building. And I am so excited for the next 5 to 10 years. Rick might tell you we're going to see what I call the silver tsunami. All of us that have a little more gray hair than we had a few years ago, who are business owners, probably looking to sell in the next couple of years, because after COVID and supply chain and interest rates, and then an election, and then immigration, and now tariffs, holy crap. I meant to sell 6 or 7 years ago. I'm still in this thing. So we have a building of supply of family-run businesses that are going to come to market. So if we build the right team now, it's going to be amazing for the next 10 years.
Yeah. So all businesses, as they're kind of scaling, I like to think of businesses as there's different functions in the business: sales, operations, finance. There's other ones as well. And as you're growing, there's a moment where there's a kink in the hose, right? A function is going to be stuck, one of them at any point in time. What have been the most difficult bottlenecks that you've had in growing your business that you've had to deal with? And how do you break them?
Me. As soon as a CEO can admit that, you know what, I can't do it all, it's been amazing. And so this is where I love, and again, not promoting EOS specifically, but having an accountability chart and being able to say, okay, Terry, you own this, and Michael, you own that, and Chris, you own this. And my official title on the accountability chart is actually Chief Problem Solver. So I don't want to get into details. I don't need to get in the details, because if you trust your team to let it go and you are able to let go, it's amazing to see what can happen. So the biggest impediment is me.
Yeah, but that's easy said, right? I mean, how do you do it? How do you actually let go?
With a lot of angst.
Yeah.
It takes a discipline. It's been a journey. As we've been doing this accountability chart for about 2.5 years now. And I'm just getting to that point now that I'm seeing the benefits of it.
How is it holding you back? So you said you were the bottleneck. What did that specifically mean? Were you not doing the things you needed to be doing? Were you doing other people's jobs?
It's really easy and comfortable to fall back into what you're comfortable in is easy, right? So I do payroll.
Mhm.
Why?
Yeah.
Doing 401k and pension plans and benefit plans and stuff like that. It's not driving the business forward. So being able to let go of some of that stuff and trust your team to do even the minuscule stuff frees up, believe it or not, if you totaled it all up, it's hours a day.
Yeah.
And now you can redeploy that time either back into your family or into another growth initiative or frankly, just thinking. It's been fun to think again. It's great. It hurts like hell, but it works.
Yeah. Yeah. So you said, you felt like you'd been a lifestyle business for a while. What beliefs have you had to change within the business when you look into the future and
Yeah.
grow?
One is that confidence in the future, and knowing that we have the silver tsunami coming. So for us, it makes a lot of sense. The other one is the acceptance of risk. We, for 30 years, never wanted to make a mistake. So we didn't hire anybody in case they didn't work out. We didn't make an investment in case it didn't work out. We didn't. And so instead of looking at what the possibilities of failure are, we looked at the probabilities of success and saying, if we hire another person and they work out, look at what could happen here. And so this is when we brought in Terry, we brought in Chris, we brought in some other folks, some junior stuff. It's been fantastic. And so we're a people business at the end of the day. We don't have CapEx, right? We don't have heavy machinery. We have people. And
Sure.
so if you make those right decisions and make the right investment in those people, it can be magical.
Cool. So what decisions specifically challenge you as the leader, and how do you deal with them? How do you think about dealing with them?
So I shouldn't say this on video right now, but right now it's gaining consensus. If it were, I'm a pushy son of a bitch. I want it done yesterday. I'm a ready, shoot, aim guy. And my team is much more methodical in getting there. So for me, it's been to hold back my ready, shoot, aim and sort of doing more disciplined approach to stuff. Bill's nodding back there because he knows Terry pretty well. But that's, so for us, that's, I think our biggest challenge right now is that my impetus for growth versus the conservativeness and the disciplined approach that others take.
That's hard. I mean, that's not always a bad thing though, right? I mean,
It's not, the balance is fantastic. It's frustrating as hell.
Yeah, totally.
But it's the right answer.
What has been the most helpful either habit or discipline that you've gained in organizing people and marching them towards your vision?
That clarity of vision. It has been enlightening. It has been exhilarating, and it's been disciplined. Now we look at deals and we said, is that our core customer? No. All right, then why are we talking about it anymore? And so now we figure out not only who we're going to go after, but we've got lots of great referral sources here in the room that call us and say, hey, would you take a look at this? And it's so nice to be able to say, no.
Yeah.
I'm happy. We're in a relationship building. So of course we're going to say yes, and we'll have a meeting and give you great advice. But at the end of the day, we're not going to take it on. And we've done this a couple of times. We're under LOI right now with a company in a technology space that we don't understand. But we worked with a company for 3 years to get ready for the transaction. They called us and said, okay, you're our guy. You ready to go? No, don't hire us. Well, wait a minute. You've been working with us for 3 years to get ready. I said, yeah, but we're not the right guys to take you to market. And so they said, we can't live without you. We're going to hire you as our chief exit advisor, and you're going to run the process for us because we don't know how to do this and we trust you. Trust, again. So you run the process. So we went out and we interviewed a bunch of bankers. We've hired a big Wall Street firm. We're now under LOI for about 150 million on a technology deal that I still don't understand the technology.
Yeah. How long have you guys been saying no, like in that capacity? Has it been years?
No.
No.
See, I'm getting good at it.
Yeah.
No, it's only been the last year or two.
Have you felt us pulling back on revenue or no?
The inverse.
Interesting.
Because we've been so public about our discipline and our focus, Now referral sources know when to call us. If you're a full service investment bank to the middle market, when do I call you? I don't know. But if you have a family run business doing their once in a lifetime transaction, chances are we're now going to get the call. So it's been the opposite. We're laying a lot of seeds right now. The market's a different issue.
Yeah.
But a lot of great relationships are being built right now because of that discipline.
How do you say no gracefully? Then not burning bridges.
There is no way to say it gracefully. You say it forcefully.
Yeah.
And with conviction. I think we find that more people respect us by, as I like to say, I would rather turn you down than let you down.
Right.
And so that actually came to I got to give full credit. My father said that. He was in the executive search business. And he said, when I turned down a deal, it's like, I could do this, but I won't do it well. So I'm going to turn you down, not let you down. And so we've inherited that same theory, that if we don't think, I keep saying this, our passion, our purpose is to deliver life-changing outcomes to families that exceed expectations. The exceed expectations is the important part. If I can't exceed your expectations, I can't go in with confidence and say, I'm going to exceed your expectations, I'm going to say no.
Do people disagree with you, the fact that we're saying no more often? And because obviously we have these tools for a reason, so you know what to say no to, but then there's the reality of people still in the business want to do it, right? So how do you balance
what do
that?
you mean? I've been working with you for 3 years.
Yeah.
No. And it is that conviction, but now they really appreciate us still being on the team, just not in the lead.
Yeah.
And so it's that we will never destroy trust. And so full stop, period. And so, and we are in a relationship business, like we all are in relationship businesses.
Yeah.
So whatever we can do to enhance that relationship, sometimes the brutal honesty, that radical candor that comes out.
So you guys could definitely grow faster. It sounds like you have the leads. It sounds like you have the structure. If you wanted to acquire other banks, you know, you could, right? So why not?
Why? Growth for growth. We were talking about it earlier. Growth for growth's sake is stupid, right? You've got to look at your core values. You got to look at your core, what you are, where you want to be. For us to go and explode, I could hire a dozen people tomorrow. But why? If they don't share your culture, they don't share your values, they don't share your ethos, all you're doing is destroying that. And that is so sacred to us that we will never jeopardize that. Full stop. So for us, we have a very methodical, we plan to grow by 1 to 2 people, senior guys, managing director levels, 1 to 2 people a year for the next 5 years. You do, and then it comes down to math.
Yeah.
Right. And that's totally sustainable. We think we can maintain our culture in that and still provide great service.
So kind of pivoting on the personal, I mean, this is business as well, but if someone was going to shadow you for a week, what would surprise them about your habits?
Hell on wheels. No, I don't know. I think we live our core values each and every day. So you talk about running through walls. We closed a big deal last Thursday. My last email was at 2:40. My first one was at 5:20. Why? Because it had to happen. And that's a daily occurrence, not necessarily a daily occurrence.
I hope
when it needs to happen, it happens. But that and the honesty, the integrity, makes more sense. And engaging personally, I had the best phone call this morning at 7:00 in the morning with the client that just sold.
Yeah.
And just, hey, how you doing? What's going on? How are the kids? You had dinner with your daughters? How did that go? That was more important to me than anything else.
What is so if we pulled up your calendar, what would it tell us?
I had a grand total from 7 this morning until 7:00. Whenever we wrap up here, I had exactly 30 minutes free today. But this is where you can rely on your team to really execute.
Yeah.
So we're busy as hell, even though there's not a lot of M&A going on, developing relations and everything else. But I've got to be, so you're going to ask the next question, what are you going to do differently? I've got to find more personal time.
Sure. Interesting. I was going to ask you about that. What belief have you outgrown as a leader? You thought in the past, you don't think anymore.
It's about the money, because it's not. It's all about the relationships and the people you deal with every day. whether that be internal or external or the team. As we like to say, you need the core four in every M&A transaction. Those people are sacred to us.
Yeah.
And so it's anybody. I was sharing, I think, Gary, with you, a client who started our conversation. We were selling, he was in a debt collections business, accounts receivable management's a polite way to say debt collections. And rough and tumble guy from the middle of Long Island, grew up in the business, second generation, nothing but hard-nosed SOBs all the way around. When we first got engaged, he said, I don't care what it takes. I want every last freaking nickel out of this place. I don't care about my employees. Like, but what about your culture? I don't care about culture. How about your customers? Screw them. Give me every last nickel we can possibly get out of this thing. 8 months later, as we're sitting around looking at all of our letters of intent, we had 4 of them to take a look at. And we had a great guy, strategic buyer, the highest price by far. Nope, don't want him. What? Second guy, private equity guy. Yeah, no, don't like him. Third guy. Yeah, I like him. But you're leaving millions and millions of dollars. Literally, I think you lost between $5 and $7 million on the table after telling us every last freaking nickel out of this place, right? Left millions of dollars on the table. Why? I like them. I think they'll do well with this. I think they'll take care of my people. They'll continue the growth of the company. Bob, do you not remember the conversation we had a few months ago? Yeah, tell me, what do you got? So yes, thank you for teeing up the obvious answer, which is we exceeded expectations by a lot. So this is free money to him. But yes, it was because he had confidence in closing. If you put, and hopefully we'll talk about it a little bit, stop talking about me. If you put the right team together and you talk about the wealth management plan and the succession planning and the taking care of the kids, and you get a great M&A attorney and you get a great trust and estates guy, and you put a good investment banker, you get a good accountant and tax guy, the confidence in closing is great. And so everybody goes in using rough numbers in an M&A analogy. Everyone says my business is worth 50 million. Why? Because it's a nice round number and it's $4 million than your buddy at the golf club, right? Well, why do you need that much? Well, I just do. Well, have you thought about it? So if you bring in a wealth manager and said, well, with some trust and estates planning, with some tax mitigation planning, with everything else, you can live with 35. Well, if he's at 50 and I sell it for 40, what happens? He's pissed because everybody's miserable. But if you come in and do the trust and estates planning and the estate, the gifting and the wealth management strategies, and all of a sudden you said, I can live with 35 and I deliver 40, what happens? Everybody's a hero. So why wouldn't you bring that guy in the room soon? Like starting, like before you go to market. So that was an exact example where he realized his number was a little bit lower than he thought it was going to be and still fulfill every lifelong financial dream. So we were above that. So it was house money, but also here's the secret to M&A. Don't tell anybody. It's not about the money. If you look at a competitive process and we do it right, we'll have 4, 5, 6 guys all within about 10% of each other. Jerry, is that about right? So everyone's going to be about 10% within each other, right? For 10%, do you really care? If they're going to, I have a client right now in upstate New York. He's got 2 offers on the table. One's thoroughly mediocre, kind of average, fairly okay. But they're going to keep the people, they keep the factory in place, can keep everything business as usual. I have another guy who's coming way over the top, wants to pay a ton of money to close down the factory. Which one do you take? Legacy. That's exactly right.
A couple more questions and we'll swap to M&A. So lots of ups in running a business, lots of dark moments. What's the dark side of running a business and being a business owner for you?
Payroll. meeting payroll every week,
Yeah.
right? Look, we are in the people business. No question about it. I got to keep all my guys happy and engaged and thrilled. And we last night, because we closed this deal last week, we took everybody golfing last night. Indoor range, couple of beers. It was great. That means more than anything else.
Mhm.
And so, but when you think and say, well, in this M&A market, which isn't great, I may not have another closing for the rest of the year. Well, how do I support my overhead between now and sometime next year
Yeah.
when we may or may not have another closing? And so, but you have to have faith.
Yeah.
And if you take the long-term perspective of this thing comes and goes in cycles, M&A cycles come and go, it's still the right thing to do. That it's the culture.
Does it weigh on you?
Every day.
Yeah.
Oh,
How
yeah.
do you balance that? Because I feel like it's easy to like fall in the manhole, right? And
It is. It's really easy to fall in the manhole.
I always struggle with like, what am I not doing at like 8 o'clock at night? I'm like, my wife's watching a show and she'll ask me about it. I'm like, wait, what did you just say? I'm like having a conversation in my head. Like, do you struggle with that? Like, I feel like being an owner, it's like, what am I not doing? Right.
But you've got to have the faith that in the long run, it's the right thing to do.
Mhm.
And so we've been doing this as a firm for 37 years. I'm the rookie because I've only been doing it for 20 here. And comes and goes in cycles. And if you build the right platform, it will come. Then you've just got to have faith. And when it does, it's spectacular. And when it doesn't, that's okay. You got to just have faith that it keep going.
I think it's easy to say. I mean, I'm sure
It's easy to say.
You're seasoned,
but
right?
actually,
So
we're having this debate right now amongst the partners.
Hard.
Of what do we do next?
Yeah.
And it is the longer term. If you look at last year, full disclosure, well, maybe it's a little too much, is the 52 weeks of 2024 was thoroughly mediocre for Carter Morse. If you extended by 2 weeks into January, it was really good. If you go back 2 weeks in December, it was fucking awesome. So why do I care about a calendar?
Yeah. Good insight.
Doesn't matter.
Yeah.
Right? So as long as it keeps rolling through you, as long as you're doing the right thing, it's
All right. We're going to swap to M&A now. So
fantastic.
We'll flex
Much better
that muscle
topic.
a little bit. So just really simple, how does the process work? So somebody that's like major steps in the process, what can somebody expect that doesn't know what to expect?
Yeah. It's hell on wheels. It's the most amazing, difficult, exhilarating, exhausting process you could possibly do. From an emotional perspective, from a diligence perspective, from a time perspective. And yet it could be, if you do it right, the most rewarding. Generally speaking, it's a 9-month process. Any banker that comes in and says you can do this in weeks, he's full of shit. Don't listen to him. It's on average. So I've done personally about 130 transactions. My shortest one is 28 days from introduction to the client to closing of the transaction. It was a year-end deal, had to get it done, gun to the head, made it happen. My second shortest deal is 6 months. And that started with an offer on the table. Tell me that anybody's going to do this. If it starts with an offer, it's still 6 months. You're not going to get it done any faster than that. It's just a process. We generally say it's about 8 months. If it takes, so it's 7 to 8 months is the normal range. If it takes more than 9, you've had a change in strategy.
Yeah.
It will never take less than 6. So understand that it's your second full-time job. You still have to run your business. You still have to do, put food on the table. You still got to pay employees. You still got to generate revenue. So this is a second full-time job on top of that.
Yeah.
Generally speaking, for us, it's about 3 months of getting ready. That involves a QV, a market study, an environmental study, really hiring the experts to get you ready for a transaction before we ever make a phone call.
Why do you have to do that? Any of that?
Planning and preparation. Anybody who takes a buyer beware strategy is going to lose. So if we're going to trip a landmine, if there's an issue to uncover, I want to do it first. And then we figure out whether that we go to market. So a quality of earnings I used to say that, and Terry hates when I say this, but we used to say the investment banker is your best investment. the Q of E guys get a better ROI. Why? Because if you're going to pay him $50,000 to $100,000 to find stuff, and he finds a couple $100,000 worth of add backs and adjustments, and then you apply a 6, 7, 8, 9, 10 multiple to that, that's worth millions of dollars to you, right? Don't worry about the $100,000 expense. Think about that as an investment in your success. Now, all of a sudden, you're making millions of dollars more, right? So the QV, and that takes—
What is QV?
Quality of earnings report.
Okay.
So you can do an audit. Most people do a review, hopefully not a compilation, but most people do a review, but not an audit, because they say, well, the audit's too expensive. This is the penalty you pay for not doing an audit for 20 years. So it's absolutely the best investment, where they'll come in and take a look at your audit procedures. They'll look for add backs and normalizations. By the way, how many people here love paying taxes? Shut up, Tom. Somebody had to be that guy. Nobody likes paying taxes, right? So how do you manipulate your income statement? You lower income, right? Right? So we all want to avoid taxes. We lower income because we can, because of the rules of the road says we can. Is that the best basis for value? No. So when a buyer says, hey, just hand me over your financials, don't ever do that, right? Go to your accountant and say, how do we reinvent this thing to make it look like it's more profitable than it is? Well, that's what a Q of E does. So they'll look back in normalizations and add backs and adjustments. If you hired and fired a sales guy who generated no revenue, add it back. If you run your country club or your cars through it, add it back, right? If shipping containers went to $25,000 in one quarter and then came back down to $3,000, add it back, right? So look at what a normal post-closing income statement would look like. Q of E. Number 2 guy you got to put in the room. This wasn't your question, but I'm going to go down this path anyway.
Go for it.
Dentists and brain surgeons are both doctors. They both went to medical school. They're both experts in their field. They're both amazing at what they do. They're both doctors. Would you ever use a dentist to do brain surgery? God, I hope not. So why are you using your divorce attorney to do your M&A deal? It doesn't make any sense. Go hire the best M&A attorney you can get, because they're going to know how to get it done. They'll get it done faster. They'll get it done cheaper and much better, right? It's a no-brainer. Third guy you need in the room is your wealth manager, trust and estates guy. There are unbelievable benefits to doing a little advanced planning. Gifting low basis stock into a non-taxable trust avoids. So if I increase the purchase price by 20%, that's pretty cool, right? If Uncle Sam takes 50%, that sucks. Why not put it over to the side so when you die and you don't need that kind of money, you put it off to the side, goes to your kids tax-free? Why aren't you doing that? And then it gets back to that confidence question of confidence of closing, that I have enough money to fulfill all my lifelong dreams, right? Bring those guys in the room. And I hate to say this because it seems self-fulfilling, only because it is. Get your investment banker in early. We know where the market is. We know the rules of the road. We know the tricks of the trade. Think about what value really means. Think about how to drive value. Valuation's super simple. EBITDA times a multiple plus or minus an adjustment. Let me start with the easy one. There's no such thing as a positive adjustment, okay? There's only negative. If you don't prepare, if shit's found in due diligence, the deal only gets worse. So come back to EBITDA, hire your Q of E firm, maximize EBITDA. Number 2 is focus on the multiple. Bring in your investment banker, because that's what we do. We focus on the multiple and how do I create more value? How do I take an industry standard of a 5 and turn it into a 7, 8, 9 multiple and go from there? So, and then plan and prepare. Nobody likes an adjustment at the end. There's always something that happens the day before closing. Get ahead of it. Don't make it happen.
So you said 130 deals. So you've seen probably some good ones, some bad ones, some medium ones. What's the patterns you see in the CEOs that get the best outcomes?
It sounds ridiculous, It's really being ready for the transition. Selling your business is a monumental event. It's psychological. It's emotional. I had a client, he ran a company called Montague. It had been in his family for 158 years. They started making ovens in gold mines during the gold rush in San Francisco. And now he makes really good high-end ovens for steakhouses. You see the transition that happened over multiple generations. He actually turned to me one day and said, "I would rather sell my son than this business." So hold on a second. Back up. What do you mean? He said, "Well, my son has been a cost center. He's just there. He's cost me a ton of money. He's aggravating as hell. He's not in the business. He's the reason I have to sell the business and everything else. But the business is my baby. It's what I wake up every morning thinking about. It's what I go to sleep thinking about every day. It's been massive exhilaration and exhaustion and enthusiasm, and it's what I live for." And so you've got to think about how monumental that transaction is. But he was fully prepared. He had been working with some consultants to think about what comes next. If you're thinking about ever selling your business, know what you're going to next. Because the best success stories, the guys that do the best transition, have a plan going forward. You cannot play that much golf. I don't care. Sorry, Sammy. I mean, maybe you can, but most guys can't. But no, you can't play that much golf. So what are you going to do next? What are you retiring to? Not retaining, where are you transitioning to? Whether it be philanthropy, whether it be family, whether it be something else, but you have to, if you've been so intense in running your business for so long, get ready, because it's going to be, you got to do that same intensity somewhere else.
So it's interesting that you say that as like the thing to be ready for is more what comes next. I was thinking more of something prior that's going to make them have a better outcome.
Well,
but why do you say that? So
yeah.
have you seen a bad outcome where somebody sells and they're like, that's unique that you picked that thing?
So this is shameless self-promotion. Here it comes. Our clients don't have that issue because we do train them up ahead. But statistically speaking, 80% of all people who sell their business regret it in a year from now. That's a horrible statistic.
Yeah, it's terrible.
And so if you really think about that for a second, what were they doing and why? So one of our key mantras, especially for family-run businesses, you got to think about what comes next. That's strategic. More tactical, it is planning and preparing. Think about it 2 or 3 years in advance. If you run the numbers, and this is what's crazy, ready? $50 million business doing $5 million of EBITDA. Sounds pretty good, right? So if you sell it now, call it a 6 multiple, just because that's where the markets are right now. It's a $30 million. Hot damn, put it in the bank, I'm good. Well, let's say for giggles that you increase growth by 1% a year. Not a lot, 1%.
Yeah.
So you should be able to find 1% of growth somewhere just by focusing a little bit. And you find 1% of EBITDA, 1% of profit per year for the next 3 years. So you go from a 10% profit to an 11% profit to a 12% profit. Guess what? You get credit for momentum. So now you're a growth company with increasing margins. So your multiple went from a 6 to a 7. So now 3 years from now, you know what that business is worth? Almost $60 million. Same metrics, same company, same doing exactly the same thing, but just by focusing a little bit on growth and a little bit on profitability, credit for momentum, you get the multiple up. Now all of a sudden it's $60 million. So simple things like that are so basic that people miss it.
Yeah. So I was talking to a couple of people in the room who are thinking about things, and how do you think about timing? Because you said it is a rough spot right now, but at the same time, how do you how do you time it, and can you? So how would you, if you're going to sell your business, how do you think about that?
So there's 2 ways to answer that. If you're a family-run business, don't worry about timing. You're not selling your business because of a timing of the market. How many of you go in and out of the stock market every day trying to time the right purchase? Hopefully not many of you, right? Because you're in for the long haul. Most guys look at their investment in their businesses the same way. What makes the difference in selling your business is really thinking about, does it achieve the objectives that I need to set out to do? What's the definition of success? We start every conversation with, what's your definition? What is it? What makes this successful? At the end of the day, it's not money. It's, I want to spend time, I have an illness, or I want to spend time with the grandkids. I don't think I can grow this anymore, or I've got a risk on the horizon I see. I had one guy, a metal stamping business up in Waterbury, said, I'm so dependent on my one tool maker. When he's out sick, the factory shuts down. He's 76 years old. I've tried for 20 years to replace him. I can't do it. And I don't want to do this anymore. It's too much risk in my life. I'm out. That was in the middle of COVID. So timing was less relevant. Don't try to time the market. Time what it is important to you. It will take care of itself. And we often recommend not doing stuff. As we were talking earlier, on the phone with a guy on Long Island that does bakery racks. Guess what? He brings in all of his aluminum and steel from China. He really wants to sell.
Probably not a good time.
Yeah, not really a good time right now.
Yeah.
And so we're working with him to say, how do we improve the business? How do we get there? And when we have clarity, if we have stability, then we'll talk about doing a deal. Yeah, part of our job is to tell people not to sell.
Yeah.
Which is really weird for an investment banker.
Yeah. So you talked a little bit about multiples. So what is the difference between a 4X and an 8X? Like, what do you see when you poke into those companies?
Great question. Boiling it down to super simple, risk. So if you have, let's take that same $50 million business doing $5 million of EBITDA, right? One's highly concentrated in one customer. One's got lots of customers. Which one's worth more? Lots of customers, right? I have no management team. It's all one guy, or I've got a diversified management team. Yeah. You look at all these things. I'm importing shit from China, or I get it down the street. Yeah. Now that's a whole new factor we're dealing with. So it is the perception of risk and the management of risk, whether that be end markets, whether that be operations, most importantly, management. Value is the inverse of risk. Anything you can do now to mitigate risk, however that may be defined, and every one of your business is going to have a different risk factor, go mitigate it now.
Yeah.
You won't eliminate it. You're a business owner for a reason. And you have to be comfortable with risk. But if you can mitigate it for the next guy, that's what drives value.
So I think that's totally true. I also see that CEOs, you have to run the business still though, right? And so looking at something and say, okay, I got to run this, but then if I'm going to sell in 2 years, I got to think about reducing risk and all these other things. It's hard to, where do I prioritize, right? So how do you actually systematically look at and improve these things over time without blowing your business up?
First of all, delegate. Living this right now. As the CEO, as the owner, as the leader of the pack, you've got to really think more holistically in a bigger picture than most people do. Most of our weaker clients or guys that aren't as successful are so ingrained in the day-to-day that they forget the bigger picture and they just sort of manage the day-to-day. So you've got to get out of that mindset and think more holistically. How do you do it systematically? Shameless plug for all the consultants in the room. Hire the best experts you can. We go into companies and say, we don't know how to make a widget, but you really do. And so, but when we look at costing analysis or operational improvements or stuff like that, it's amazing what the return can be.
Yeah.
For example, we worked with a food company up 95 a little ways, that nice business. They had an offer from a multinational strategic buyer, attractive offer for what they had. And we walked the factory floor and saw a lot of tanks like this and said, well, why are they idle? Why aren't they working? Why is the inventory covering the front of this thing? Why is it? And so we knew enough to say, this isn't right this is where investing in your success is really important. We had a $20,000 assessment that led to a $200,000 project that led to $2 million worth of cost savings that we presented to the buyer. They paid us 10 times, including the $2 million of savings. We didn't have to do anything,
Mm-hmm.
but we identified the problem. We had a plan of action to execute against, and the buyer bought it.
Interesting.
Hire the right guys to figure that out.
Yeah. I've been thinking about that concept a lot, that it spurts me, like, net income, net margins in a business don't improve unless the CEO chooses them to, because nobody else is going to go out there and say, I'm going to improve these margins, right? No one has that skin in the game. No one has the sense of urgency. And so it's so ironic that at any given time, there's probably 3, 4, 5 points of margin that if the CEO chooses, we're going to improve this, exist. And so I feel like it's just a consciousness of this quarter, we're going to look at price. We're going to take all those discounts and we're going to kill them.
I was talking to a CFO recently who was presenting to the board and said, well, the closer the client is to the CEO, the worse our margins are.
Mm-hmm.
So as soon as you extricate yourself from that and look at it clinically,
holistically,
now all of a sudden it's pretty amazing to see what you can do just by saying, oh, well, maybe I'm the problem, or maybe I can do this again.
Yeah.
I was talking to another folk that I would say a different story, working with a chocolate cake company on Long Island. Price of chocolate went through the roof. And they said, well, we can't raise prices. We can't raise prices. We can't raise prices. And so we finally said, you have to raise prices or you are out of business. And so they sheepishly called a couple of their crappy customers that if they left, it wasn't a big deal. And they're like, well, we've been waiting for this call. You're the last guy to call us. Everyone else is already here.
Yeah.
Right. And so they just worked their way up the food chain and all, literally. And so they got to their biggest client and they said, yeah, no problem. Of course. So all of a sudden,
it's just fear. Yeah.
It's the fear. And if you have that discipline of maximizing value, however defined, and that focus, it does make a difference.
So somebody's getting ready to sell 2 to 3 years. What are top 3 leverage points?
Yeah.
Like, if they had only time for 3 things, what do they do?
Good question. First of all, I always hate that 3-year timeline. The EPI, Exit Planning Institute, puts out a study every year. And for the last 20 years, it has said most business owners think about selling their businesses in 3 to 5 years. Why? 3 years is close enough that I don't have to do anything about it. 3 years is close enough I can taste it. 5 years is long enough I don't have to do anything about it.
Yeah.
So what happens? All these businesses stagnate.
Mm-hmm.
As I like to say, you get credit. So the best answer is you get credit for momentum. If you stop making investments, there's a discount. So keep making investments. Invest in your management team because that's what they're buying next, right? If you want to get out, replace yourself now, and make sure that transition goes forward. And think about mitigating those risks, however you define them in your business. But it's amazing to see with a little proactivity and a little clarity 3 years from now, what the outcome can be. You just statistically on the number side alone, you can double value in 3 years. Imagine if you also made the right investments in people and process and risk mitigation. It can be amazing.
So what are the biggest things that blow up deals?
Anything. We have seen just about all of it. I would say the biggest thing is a mismatch of expectations. If you tell the potential buyer or investor all the wonderful things that are in your business without telling any of the vulnerabilities, as we like to say, there's no such thing as a weakness, only an opportunity to do better. So let's say I'm selling a business and I get a hole in my production capacity here. So I'm going to go to all of you guys and say, I want you to buy my company, but you're the only guy that knows how to fix that. What happens at closing? You guys all see risk. You're like, I'm not going to pay a lot for that because you got a problem over there. But you say, oh my God, I know how to do that. That's not a risk to me. What happens at valuation at closing? Who's going to pay the most? That guy. So that's number one, is be really forthcoming about your weaknesses. Mm-hmm. You cannot put lipstick on a pig. It should not be buyer beware. They always find out. The second one is have a really, really clear vision of where you're going. The guy that buys into your vision, the guy that wants to back what you've built so far and can accelerate that, is also the guy that's going to do not only pay the most today, but do better with it in the future. So admit you're weak when you are, and have a clear vision.
So I've heard this from a lot of people that I've spoken to or that I'm coaching around exiting, and they're nervous between selling it to somebody that does what they do in their space and selling it to a private equity company? How do you advise in those types of scenarios?
It depends on what client we're talking to.
Yeah.
Every private equity guy, like Gary, hates strategic buyers. Guess what? Every strategic buyer hates the private equity guy because they drive up value. The whole thing is BS. So for us, it's less about strategic partner versus private equity. It's about who's the right partner for the company going forward.
Yeah.
If you share that vision, you're admitting your weaknesses. It is about that partnership. Gary and I were talking earlier, most private equity guys, when they make an investment, expect to double, maybe triple their money over the next 5 years. And there's all sorts of statistics that prove that. Our clients, when they find the right partner, have been on average 4 to 5x their rollover investment. So they found the right partner. We had one guy that made 9.5 times his rollover, which means he made more money on the rollover than he did when he sold the business to begin with. And guess what? He found another private equity guy that was even better. He rolled it again. And so if you focus on partnership, not that money, because if you find the right partner, it's magical. So whether that be strategic or private equity, you don't need to, so we come back to process for a second. We typically go to 40 to 50 buyers, partners, right? A mix of private equity and strategic, depending on what the priorities of the owners are, what the definition of success. You don't need to go to hundreds or thousands. But now if you say, well, let's curate that list and go after who's most important, you maintain confidentiality, you maintain control, and you find the right partner going forward.
Yeah. So one of the other things that I think I've found surprises entrepreneurs is the terms side of the deal and getting hung on the hook for some of that. People think you get the cash and just run, right? But then there's the earnouts, there's the other things involved. What should somebody expect if they're going to sell the business in terms of how they're going to receive the money and what they're going to be on the hook for?
Again, start with the definition of success and figure out what it is you need out of the transaction first. Generally speaking, strategic guys will pay cash at closing. You'll be on the hook for some earnout or from some escrows for reps and warranties, but we can put an insurance policy there and everything else. So cash, if your objective is to cash at closing and not worry about any upside, strategic buyer is probably the better way to go. If you go to a private equity, they want you to have skin in the game. Generally speaking, we like to see 20% rollover. So if I sell it for 100 million, you get 80 at closing, 20 million is reinvested in the next company. Why? Because everyone's still aligned. If I put $80 million in your pocket, if I put $100 million in your pocket, you're definitely not coming to work tomorrow, right? If I put 80, you're net 50 after cash, you're probably still there. You may or may not come to the office, depending on your style of living. But if you know you got 20 million left in the company, guess what you're going to do? You're going to try to maximize that. You're fully aligned to do the right thing for that partner going forward. And so they want to see you roll over equity. They want to see your management team roll over equity or incentivize equity so that we're all singing from the same song sheet going forward. So, but start with your definition of success. We've often seen folks take 100% cash, lower amount of value versus a higher value, but roll over equity. And we've seen the inverse.
Right.
Start with success and work backwards.
All right. One more quick arena and then we'll open it up for questions. And I know this isn't really your world, but I'm sure you have a take on it. On the acquiring side.
Yep.
So, someone in the room wants to go on an acquisition spree. How would you advise them to think about that? And what makes something a clean bolt-on versus maybe a messy deal?
Wow. Really big question.
Yeah. You can break it apart if you want.
Yeah. First and foremost, I think it still comes down to the people. We did a wonderful deal for the New Dine companies, Hubble hot water heaters, in buying a company called Warren Electric up in Warren, Rhode Island. Great cultural match. They knew each other well. They were a vendor and a partner already. They knew each other well. It was a seamless transition. I won't say it was easy, but it made a lot of sense. And so it was one of the best acquisitions we've made, although small, one of the best acquisitions we made because it made so much sense for both sides, right? So that's where you start.
Can you be more specific? So sense being, you said people,
Yep.
vendor, industry,
So
anything else?
yeah. I think so. On the people front, it's that culture. Are they going to buy in? Are they doing it? Believe it or
Yeah.
not, the daughter that was running Warren wanted to put Warren on EOS, and Newdine was already on EOS, and so already you had that
You
cultural
don't have
match of what we
both
wanted
sides
to do.
fighting each other.
Yeah.
Yeah.
So it was perfectly symbiotic. The other question is from an acquirer perspective, as we were saying before, can you solve the problem? If you've identified the risk, how comfortable are you that you can actually solve that? So there's a great company up in Westchester County called Sawmill Capital. They're operational focused. They can do, and I shouldn't say that, they are sales focused. They are so good at fixing sales that that's what they look for in their portfolio companies. If there's an under sales capacity, that's what I'm really good at fixing. Or there's another guy that only wants to do operations. They want to bring in all their operational experts and go solve that problem. So if you can solve the problem, whatever it may be, to create value, that's the other way to look at it. In the end, yeah, people and process. The other thing you look for in a deal, I think, is access. And I say that really broadly. It's access to people, it's access to technology, it's access to new markets, a new customer base, whatever it is, whatever's missing in your company, how does that fill the void?
Sure.
If you're doing more of the same, why? I would rather, does it make sense to do that or not? Then it's just a value question. But if it solves a problem or fills a void, gives you access, I think that's really important.